So is the housing market going to get to 2008 levels?
Like you did in 2008.
Well, numbers are really pointing in that direction, and I want to really jump into this, guys. My name is Orlando, and welcome to my channel. We are going to jump into these numbers that came out by Freddie Mac that is stating that we're going through one of the biggest contractions since 2006, guys. So we really need to understand this and understand what does this mean for the impending housing market crash that is incoming, guys. It says the housing market is entering the most significant contraction in activity since 2006, says Freddie Mac economist. The pandemic housing boom is finally running on fumes. Home sales are falling, inventory is rising. I've been telling people inventory will continue to rise because people are not buying homes. If people stop buying homes, inventory will always rise. People still need to sell homes, guys. And home sellers are cutting listing prices at the fastest clip since 2019. The great deceleration is a lot bigger than a seasonal cool down. It's not really even a seasonal cool down right now. This is the time that most people sell their homes during the summer. The summer is peak selling season, guys. There is no way you can call this a seasonal cool down. The economic shock of higher mortgage rates means borrowers are getting stretched thin to a degree unseen since 2006. That's why home shoppers in April and May finally balked at record home prices. This shift, Moody's economist, is the start of a full-blown housing correction. Well, really? Really? Is it all these price cuts that we're continually seeing on Zillow, Redfin, Realtor, like all of these price cuts that you can go around your local area and see? You're thinking, this is a cool down? This is a time where people are balking? Well, of course, people are balking because, like they said in the article, and like we've been covering on this channel. And if you aren't subscribed, guys, what are you doing? What are you doing? I got 80% of you guys watching this video right now that aren't subscribed. Come on, subscribe to me, subscribe. But like I was saying, when you have interest rates going up so high, and we have 4 more interest rate hikes going to happen this year, guys. Now, what does that mean? That means that every single time they increase interest rate, guys, every single time rates are going to increase in some shape or form, and you have to be ready for that. And buyers understand this, and they want no parts of it. Who wants to? Currently, interest rates are almost at 6%. So if rates are almost at 6% with 4 more rate increases, where do you think they will be? It will be 7, 8, 9, whatever, right? It's going to be high. And with individuals understanding that the interest rates are going to be high, who wants to not only pay high interest rates, but overpay? And we know what the motto of this channel is. Do not overpay. We got to remember this, guys. Overpaying with high interest rates equal no one wanting to buy houses. And that's the problem. When people were overpaying, they were okay overpaying at 2, 3, 4%. But once we get into the 5.5%, 6% and beyond, no one wants to overpay. Once again, if you watch my previous video, we know that if interest rates go up 2%, it is a decrease in buying power of $200,000. So no one wants that. No one wants to go from a $300,000 to a $100,000 or $500,000 down to $300,000. No one wants that. Most home buyers want to buy the most that they can afford when it comes to homes. And hey, look, I know there's someone in my comment section who's gonna be like, no, Orlando, that's not me. Okay, I understand it. I'm saying majority of people, most individuals want to know how much house can they afford, and they're gonna go after those homes that they can mostly afford. Now, just because a bank gives you $400,000 doesn't mean that, you know, they're maxing you out at 90 something. They still consider your debt to income, and it's normally within that 35% range. Then the guy predicts that year-over-year rates of U.S. housing price growth will plummet from an all-time high of 20.6% to 0 by next time this year. Really? I mean, we're not going to have 20.6% year over year like some of these guys in my comic section are saying. One guy in the comic section said, Orlando, we're going to get 32% year over year every year for the next 10 years. I mean, yeah, I mean, that's great. I mean, if you're a homeowner, who wouldn't love that? I mean, but we know that's not true. On Wednesday, we learned that U.S. purchase applications last week were 20.5% lower than the same week in 2021. Compared to the height of pandemic housing boom, purchase applications are down 40%. Well, yeah. Like I said, no one wants to buy a house. No one wants to buy a house, guys, when interest rates are so high and you continue to have overpriced homes. Even though people are doing price cuts, they're price cutting on a overvalued asset, a home. And then it shows here this tweet. The U.S. housing market is at the beginning stages of the most significant contraction since 2006. It hasn't shown up in many data series. Now, this right here in this chart, if you take a look at it, you can see that it's going up and then it has a massive dip, a decline of 70%. Then you can see back here in 2021, you can see that there's a decline of 40%. Right here, another drop, and it's going to continue to go down, guys. It's going to continue to go down, and there's not much we can do about it. Not much at all. Over the past year, the monthly principal and interest payments on new mortgages shot up a staggering 35%. For perspective, the private sector wages grew about 4.8% over the same period. Now, we understand that is really what the biggest issue is. We have continued everything going up high, inflation, gas, groceries, labor, everything is going up cost-wise, but wages are still, they're stagnant. They're not going up at the same rate as everything going up. So now let's just think about this, guys. We have 4.8%, it said, in wages grew, but we have inflation that is at 8.6. So basically you're wiped out and you're overpaying 4 point whatever, almost 5%. The math doesn't make sense because there's no gain for the home buyer. Wages didn't go up, but everything else goes up and now you're negative. That spike is a direct result of both record home price growth and higher mortgage rates. It also adds up an additional $670 per month, which is basically killing affordability. Now you can obviously see this home price growth. You see that in 2007, 2008, it was at this red and then it's going back up, and then it's continuing to go up, which is the reason why I'm telling individuals to stay on the sidelines, guys. Stay on the sidelines. Do not go ahead and decide to go ahead and pull the trigger when you know interest rates will continue to go up, when you know interest rates are already high, when you know that prices are already high. Let's look at this chart that we're just talked about, and we can see right here at the very, very top, it's at 20%, and it's still high in 2021. So when you see these price cuts for 20% off, you're paying 20% off of a $100,000 overpriced home. So you're really paying $80,000. You, my friend, have just not gotten the deal. So please sit on the sidelines and just watch this play out because it will be to your benefit, in my opinion. Obviously, you have to do your own research to make decisions for you and your family, but do take in consideration that this is a great starting point for information and data to make your decision. So let's talk about, is the housing market going to get to 2008 levels? Well, there's a lot of things that still have to come into play, guys. We're starting to see the slowdown right now. We're starting to see things stack up. We know, heck, if you're looking at indicators, have you guys seen Bitcoin? Ooh. It dropped. It was already dropped. It already got cut in half, but now it got past 30,000. It's at like 23,000 something. Man, so if you're looking at that, it's probably the Great Depression for you right now if you're in crypto. But on the housing market, there's a lot of things that still have to happen for us to get to 2008 numbers. The biggest thing for me is we have to see jobs start getting cut. That's when you really know things are really getting bad. And we're starting to see some of that happen, but we're also getting reports of solid job growth. But here is the thing, guys. The reason why we have job growth continue to happening is because everybody still has a little bit of money in their pocket, but with things being so high, gas prices, groceries, everything continue to go up and inflation continue to creep up. It's at 8.6%, probably higher than that than reality. With that being said, if you have all of that individual savings account, checking account, people money in their pocket will shrink. And once places like Walmart, Amazon, which we've already seen, Target, All of these kind of like indicators of everything slowing down when it comes to spending. Companies will have to start cutting massively because individuals will start pulling back and not spending. And I think you will start to see people cut back on Netflix and, spending on Amazon and stop going out to eat. And all of that shrinkage that you will start to see will start making companies start cutting along with the housing market. And that's where the recession will happen, guys. Will it get to 2008 levels? We'll have to see. We'll have to see. Time will only tell, guys. But once again, guys, I hope you got value out of this content. I'm gonna need you to watch this next video here. It will help you understand this crazy housing market, get into your first rental property. Also, check in the description. We have some useful links of getting some free credit report. Also, join my membership program. Make sure you subscribe, and I will see you guys in the next one. Thanks.